Folks, we are really, really lucky to have this gentleman on the show each and every week. Why do I say that? He is housing Lance Lambert at Resi Club. To show you how engaged he is, he just put out a report talking about non-renewals. We have talked a lot about insurance since the LA fires, and he has put together a map looking at where non-renewals are happening the most. He's done that. He's also done some work on institutional buyers. That and much, much more. Mr. Lance Lambert, thank you for being here.
Yeah, thank you for having me, Zuber. Housing. There's always so much going on. And, I really just appreciate you bringing me on every once in a while to talk housing and really get into the data, the maps, and, just have these discussions that you don't see in a lot of places online.
Absolutely.
Kind of get to the hard data, get to the truth.
Yeah. Well, let's look at it, but I've talked about it theoretically. I have been personally impacted by non-renewals and cancellations, but I'm curious, how widespread is this insurance?
Yeah. So let's take a look. I think the big thing, and this is a report I sent out to my Resi Club Pro members, so this is paywalled, but I'll show it up for this discussion. The big thing to keep in mind is that we are passing through a home insurance shock. And so what's going on there is that even if you're in the markets, in Michigan, or maybe Michigan's not the best example, but Ohio, Indiana, Oklahoma, Idaho, even these places that are far away from hurricane risk, they're still seeing a big jump in home insurance if you zoom out. So double digits, 25, 30, 40%. And a big part of it is we had an overheating for home prices and construction costs, right?
Yep.
And that cost of replacement is much higher now. So if you have a damaged home, it costs more to do a roof, more to, repair it, right? If the home's completely gone, right, it costs more to go out and buy another home, build another home. So the cost of replacement matter for insurance. And so I call this the echo pandemic housing boom, where we had a really big overheating for house prices, construction costs. And now that's really just feeding over into the home insurance market. And so there's a push up across the country because of that echo wave. Now we also have other things. There are parts of like a secular cycle that's going through the insurance market, where they're determining based on their risk models that some of these markets are at higher risk for disaster, right? And, a part of that is that we have also built a higher concentration of the U.S. housing stock into the riskier areas in the country. And then, by the way, the new product that's being built in the country, even in places outside of Florida, it's often pushing development into flood areas or places that, have been less desirable land-wise. And that's why they weren't developed 50 years ago. And so now we're pushing more into those areas. And as the housing stock moves into those higher risk areas, it increases the upward pressure on insurance. And with the insurance stuff, I've been trying to track this closer. You got to meet him. I had John Rogers, the Chief Data and Analytics Officer of CoreLogic, at Resi Day. And John leads a team at CoreLogic of 200 data scientists and meteorologists doing risk assessments on every individual property and home in the U.S. And insurance companies buy that data, and it feeds into the risk models. And let me see if I can pull up his slide of the reasons that he says that insurance is up. Give me 1 second. Here's his 6 big: the natural disaster frequency and severity, risk concentrations, and more homes into those risk-prone areas, construction costs, the cost of replacement, that's like the housing price echo pandemic housing boom. State regulations have caused a retreat from high-risk areas. State lender of last resort is playing a role, and reinsurance costs are having an impact.
Yeah, insurance is a big, again, I'm in California, mainly market. And one of the things that's unfortunate about California is there's been some regulation put in place where insurance companies can't raise prices above a certain level. And that's caused insurance companies to frankly flee So they're just not writing policies. One of the saddest things out of the LA situation, other than the tragic loss of 26 lives, was I think it was State Farm. It might have been somebody else who had just canceled policies of like 1,800 people a few months before. And you're absolutely right. The rise in property values, the rise in commodity costs, the rise in labor made it so insurance companies can't be profitable in California. So yeah, a lot of pain in California insurance.
And then here's the non-renewals across the country. Florida, parts of coastal Carolina, parts of California have seen the highest number of non-renewals. Non-renewal rates are up about double for the U.S. And going from like 0.06, so less than 1 in 100, to now it's like 1.5. So it's not like a huge number, but you go through Florida and there's parts of Florida where, you know, non-renewals 4, 5, 6, 7% jump.
Yeah.
And then into the Carolinas, same thing, some 7s, 8, 9%. There are parts of the U.S. that are up 16%, some very small pockets, but the U.S. nationally, like 1.5%. And again, and you did bring up another great point, which is builders have not seen much relief from construction cost, despite rates moving up, despite an improvement in the supply chain. You haven't seen the nominal prices to actually do things construction-wise come down much. This is a new chart I just got from National Association of Home Builders, did this data this week. Framing is the one area really where builders have seen real relief, where the typical home going from 60K on it to about 50K, so about a 10K drop. And this is for a typical home of about 1,600 square feet, so a little bigger, price around 600. But you look at this, the blue, which is 2024, is more expensive than almost everything, other than like a little thing here or a little thing there. And the only real reason that framing has come down is lumber, where remember during the pandemic housing boom, there was not only an increase in housing demand and multifamily and single family took off, but there was the remodeling side, right?
Yep.
And remodeling, you know, all these people work from home, stuck at home, and were wanting to do projects, right? And so lumber got squeezed, and we went from $300-400 per 1,000 board feet of lumber, and we hit 1,400. In the futures market, it actually got to 1,700. We were seeing 300-400% in the cost of framing lumber, which just soared. It was a huge hit to builders. We've seen that come off of that, right? The remodeling, you know, I'm not saying the remodeling market's weak, because it's actually been an area of resiliency that's holding up construction employment. But it's not what it was in summer 2020, right? When nobody had anything to do and they were just doing projects they had put off for years. And their wife was there every day getting on them to do it. And so we're not seeing that. And then multifamily, of course, that market has rolled off of the highs. And so that's kind of weakened the lumber side. And so prices have come off of that for lumber. But otherwise, you know, cost of replacement's very high. And that's put upward pressure into the insurance market. And some of these insurance commissioners who are politically appointed have resisted some of the increases and turned them down. I saw in North Carolina, they were actually requesting a 40% jump last year.
Wow.
So I'm not sure if that, you know, because it keeps getting denied and they bring it down to like a single digit. I'm assuming that's probably playing a role in what's driven up. And so of the 3,000 counties in the U.S., you got a few that have kind of hit a double digit.
Look at that.
Rate, where nationally we're at 1%.
Yeah.
And here you can see the change from 2019 to now, where Florida back in 2019, it always had a little bit of a higher non-renewal, but now it's gone from 1 to 3.
Yeah, it's tripled.
Louisiana from 0.5 to 1.8. So not talking about like a huge number of homeowners, but you are seeing a hit there. And one thing to keep in mind about the U.S. housing market, another thing, is that we have seen a secular shift. And anytime I use the word secular, it means it's just not like economic cycles, right? It's It's actually something in the real economy that's driving it. And we have seen a shift in the economy where the distribution of Americans is getting older, right?
Yep.
You have the birth rates that have continue to fall. You also have this baby boomer wave, this larger cohort. And then behind them, you had a fall off in population for the Gen Xers off of that boom, and then also abortion and stuff like that in 72. So it's the secular move has created a shift of the population getting older, right?
Sure.
So what happens when people get older? Well, the number of mortgages that are paid off gets higher, right?
Correct.
And so you go from a place in 2010 where 32% of all U.S. mortgages had no mortgage, 32% of U.S. homeowners did not have a mortgage on their primary residence.
Yep.
Now it's 40%. 40% of primary homeowners in the U.S. have no mortgage, 4 in 10. And one of the things with insurance is that if you have a mortgage, you have to have insurance, right? It's part of it's
part of the deal.
Yes. If you don't have a mortgage,
self-insured is a possibility.
And so, especially because the people who are more likely to not have a mortgage are older Americans on fixed income. And as these carrying costs have increased onto the insurance side, and this is really a story of like Louisiana and Florida, some of these older homeowners are not doing insurance because they can't afford it, right? Yeah. And so some of those are where you do see pockets of distress when you get a Hurricane Ian, right? Or maybe you get a Hurricane Milton. I know, I'm talking to, there are, anytime you have one of those situations, you're going to have some people who are getting pinched pretty hard out in the market.
Yeah. But I think this is a story that you will be covering for the next several years, because I think this secular change is not over. We'll be talking about insurance cancellations next year as well. Let's hope it gets better. But let's transition to institutional home buyers. What's going on in that market?
Yeah, so this is a report I sent out to my Premium Resi Club Pro members yesterday, looking at Wall Street's continued caution, why institutional landlords are still sidestepping scatter site home buying. And when you look at the hard data, and I'll get to it here, the share of transactions in the housing market, and this is new and existing, that are being done by institutions is very low right now. So during the pandemic housing boom, it got up to an all-time high of 2.4% in Q2 2022. And here you'll see it at 2.2%. So that pretty much means that institutions were making up one of every 50 transactions. Right?
Yep.
And while it wasn't a huge share, if you go back and look at where we were in 2019, 18, 2020, it was a lot. It was acceleration, right? There was a lot of capital getting deployed relative to what had been happening in the past to scatter site home buying from institutions, to BTR, all of that stuff, right? There was a liquidity, almost a bubble that moved through the liquidity markets because the Fed went out and bought so many treasuries and mortgage-backed securities, and it pumped so much money into the institutional and financial markets, right? And so it had to deploy somewhere, and it was seeking returns. Obviously, a lot of it went to traditional commercial real estate. A lot of it went into, all different types of investment, stock market reward, all different types of assets, right? Single family was one area where there was a lot of deployment from the institutional side, in particular into places like Dallas, Phoenix, Houston, Charlotte. Actually, those 6 markets, Charlotte, Tampa, Atlanta, Dallas, Phoenix, and Houston, those 6 are home to 36% of all institutionally owned homes. So there was a movement in capital, but as soon as rates shot up, right, as soon as the capital market shifted, you had a huge deceleration in 2022. And the thing to keep in mind here is we're now at 0.3% of all transactions are institutions. So we went from 1 in 50 to 1 in 300. But the other thing to keep in mind is we have 1.5 fewer transactions occurring. So not
Exactly.
only are they a smaller piece of the pie, but the overall pie also shrank. So,
Exactly.
so the big reason here is that when you factor in how high home prices have gotten, the deceleration in rent growth, higher maintenance cost, higher carrying cost, think property taxes, insurance.
Mhm.
There's just fewer homes available that offer the returns that the big investors are seeking. Because when they're deploying capital, they're looking across a whole spectrum of
Yep.
different assets, right? That and where they can get returns. And one of those is actually 10-year treasuries, right?
Exactly.
And
Yeah.
we're at what, a 4.5.
Yeah.
So when you factor in the returns and expectations, and then where the financial markets have shifted to, there's just not as much capital coming into the space. And so what would change that is if home prices fell more, if rent growth accelerated, or interest rates decreased. And it would need to be around like a 10 to 15% drop in home prices, or a 1.5% decrease in rates, or rent growth, accelerating. I forget what the number, I don't want to speak offhand. I forget if it's like another 10 from here. But right now, the bigger dogs just aren't deploying as much capital into the space. And then
Yeah, I guess what I'm seeing with the bigger dogs is also, I think a lot of them. I just watched a report from J.P. Morgan talking about the real estate super cycle coming. I think a lot of the bigger money is starting to shop in commercial, where the distress really is. If you want to go somewhere where prices are down 25%, go to Class A commercial multifamily. You want to shop where there's 50% discounts, go to commercial office space. So I'm seeing a lot more big money go after what they traditionally did, because that's where the stress is. That's where the debt's blowing up. You're not going to get a foreclosure wave in single family homes. I'm sorry, it's not coming. But you are going to get a lot of pain in the big commercial stuff, which has bad debt structures, overpaid, bad assumptions. The real estate super cycle is coming. It's just most people are going to miss it because it's not in single family.
And so like Roofstock, which they were at Resi Day speaking just like you were, when Dennis Braun, who is their SVP of operations, was on, he said that when he was on stage, he said many of the major institutional landlords they assist in purchasing homes have purchased zero through the MLS since
Yeah.
2022. And I believe he said American Homes for Rent. I think he might have even said Invitation. And I'll get to them in a second. But what you're not seeing necessarily a huge ton of like selling from the institutions, but you are seeing like one here or there where they ran into problems with their fund because they grew so fast so quickly. So one example is Vinebrook Homes Trust. And back in 2018, and I went through all their SEC filings, they had 4,000 homes they owned in November 2018. By Q4 22, so 4 years
Wow.
later, they had gone from 4,000 homes to 27,000 homes. Now, every once in a while, they were getting a 500 portfolio here, a 1,000 portfolio there, but they were going so fast. And then by late 2023, they had an SEC filing where Vinebrook told investors that the company has significant debt obligations coming due on the warehouse facility on approximately 1.2 billion in debt within 12 months, and blah 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 blah. To satisfy, the company does not have sufficient liquidity to satisfy these obligations. In order to satisfy obligations as they mature, management intends to evaluate its options and seek to. And then because it was such a long graph, sell. One of the options was sell homes from its portfolio,
Yeah.
pay down debt balances, and that's what we've seen. So they've sold off 3,900 homes. They've gone from owning 27,000 homes to owning 23,000 homes, so 4,000 drop. They have not bought a single home in 7 quarters.
Wow.
They've just been doing dispositions. I will say the disposition rate has decelerated. It's
Sure.
now like, what is that, 300 per
Yeah.
quarter? And one other thing about Vinebrook that's interesting, this is a report I have from 23. And you can see here every once in a while when these bigger companies do dispositions, while it's not going to create a lot of supply in the national market or your state market, you could, down to the zip code, see opportunities happen in
For
both.
sure.
So like these Milwaukee, Pittsburgh, St. Louis zip codes, at one time, they were 20, 30% of all homes.
Woo! Wow. Move the market by yourself.
Because these guys, they just play it a different way, where they're like, some corporate office and it's a spreadsheet and they're like, you know what, we're out of these areas. And then they just make it happen.
Yeah,
But Vinebrook, the interesting thing about Vinebrook is that they are very concentrated in the Midwest. They were actually started, I believe, in Dayton, Ohio, so closer to me. And before they went and started expanding and started to have SEC filings, they were just in Ohio, Kentucky, and Indiana. And then they burst into more of the Midwest, including to Wisconsin, and then got some southern portfolios as well. But what makes them unique also is they play at a much lower price point and rent than these other players. You can see it here. They don't really see themselves as having it. I pulled this from one of their financial reports. They don't really see themselves as having many competitors, because Invitation, kind of at the 2,200, American Homes for Rent, which I'll show you data on in a bit, they're kind of building bigger homes relative to what Vinebrook was doing. And I think I did. I guess I didn't put too many examples. Yeah, like this is this is in my market here. This was for sale in 2023 that they had listed for just 100K. You can kind of see it's just like they were buying at the very, very bottoms of the market. And let me go back to that study. So one thing that's interesting is, while you've seen a huge deceleration in scatter site home buying, where you're still seeing some institutional capital is build to rent, where with a scatter site portfolio, there's higher costs because you're maintaining a portfolio of homes all over the place, right?
Yep.
And so logistically speaking, it kind of eats into some of the returns, right? Whereas if you have a community where it's all the same product, so if you have to fix something, you know exactly all the parts to order, right? Because you build it, you know the inventory of parts. It's one product, right?
Yep.
It's in one place where you can maintain it, and you can kind of and when you're kind of trying to get these listings, it's also a very similar type of renter for all of them, right?
Yep.
And so you're still seeing some capital there. This is American Homes for Rent. Black here is dispositions. So you see they really stopped dispositions when home prices were ripping. Then as the market shifted, they're back to doing normal dispositions, probably a little bit above, because they didn't do, they grew a good amount during the boom and didn't do disposition. So that's kind of, they're culling through their portfolio a bit.
Right.
And then on the scatter site, which this dark red is either a scatter site home buy or they bought some from another builder.
Got it.
They've really just stopped scatter site home buying. And then this lighter red is build to rent. And what they've done at American Homes for Rent is, back in 2017, they created an in-house home builder.
Yeah.
And so now they're building homes. They are and I don't want to, they're the 39th largest home builder in the U.S.
That's amazing.
And
wow.
And so here you can see them down there, Lennar and DR Horton, Pulte Group, NVR. They're the big dogs, right? But still, AMH to be 39.
That's crazy. Top 40.
Yeah, and so you can really see they're still doing build to rent, still moving forward. And of their portfolio, they own about 59,000 wholly owned single family rentals. 10,000 of those were built by AMH. Wow. And they have another 9,600 that'll be wholly owned build to rent in their development pipeline. They have like another 600 that are like jointly owned. They're doing 3-bed, 4-bedroom, 5 bedrooms.
Wow, big stuff.
2,100 square feet. Yeah. So what it is there is that the area of opportunity that they see is that not only can they get out of some of the cost from scatter site portfolios, but they also believe that they're attacking the missing middle. And so it's these townhomes. It's a single family that's kind of that in between, where like in city, we have a good number of multifamily, right? But we don't have a lot of like the townhome communities that are like at a reasonable price for somebody who's like 25, 35. They're just starting a family, right? There's not a lot of that single family inventory available for sale. It's a lot of what was not built following the GFC bust. And so when you hear build to rent single family, they're not always like normal single family that you would think of. Some of them are townhomes. Some of them are cottages, attached cottages. It's a lot of that product that's kind of in that kind of in between. And so of the 100,000 build to rent in the pipeline in the US right now, I think 30,000 of it's closer to what you would think of as normal single family. And then a lot of that next is kind of like a little bit hybrid, some of the attached cottages, townhomes, a lot of that type of stuff. And so you can see here, AMH in Q3 2021, build to rent, their in-house builder was 27% of their acquisitions. Now it's 98, 99% of all their acquisitions.
Wow. Wow. This is amazing stuff, folks. If you don't know, you got to know Lance Lambert Resi Club is the place for housing. Has free articles, has a paid site. And oh, by the way, he's got all this data behind the scenes that you need to see. Just go to resiclubanalytics.com, put in your email, and you will get free articles a week. But you also, if you got the paid version, get access to data and so much more. Lance, you're amazing, buddy. Take care.
Thank you for having me, Zuber.
You got it.